Financial Reporting and Statement Analysis, MBV1 520. Chapter 4, Credit Risk Analysis and Interpretation. This is a very important chapter. Not that the others aren't, but this one's also very important. Because this one talks about how are organizations' credit ratings determined? What do they look for, these credit rating agencies? And how do their credit ratings affect them from getting financing? So there's a lot of areas that's very important. And you, as a valuator, need to understand this. Because as a valuator, or appraiser, you need to be able to determine where this company is heading, what's its potential, and if it has bad credit ratings or due to heavy debt, that's an indication of a declining in value. So all this ties in ultimately to how we go about doing valuations. So what's the market for credit? I mean, some of these I want to talk about real quickly. I mean, a lot of the times you're going to hear about supply and demand in this particular chapter. We're going to talk about Porter's 5 forces and all of this stuff that you're probably all familiar with. But generally speaking, the market for credit is demand and supply. Who's demanding the credit and, why they're demanding it. It could be like the statement of cash flow, right? Most companies either need credit for operating expenses, investing expenses, or financing activities. And who's the suppliers? Creditors, banks, public debt investors, insurance companies, private lenders, and now even the latest techniques is in the United States we have crowd financing or crowdfunding. The maximum amount of debt investor is determined by the interest rate set in the loan and the prevailing market rate of interest. So we're going to be talking about all this stuff. And the credit demand for operating, remember, we're looking at the statement of cash flow, operating, investing, and financing. When you look at credit terms, it's based upon past experience. I mean, have you been a good payer over the last several years? Have you been late payments? I mean, is your balance sheet laden with all this debt? I mean, like anything else, they're going to be judging you. Routine low-risk needs created by, it's just, what do you need this cash for? Is it for operating cash, for materials and labor? Is it advanced seasonal purchases? I mean, if it's used for routine business operations, there's really no issue. But if you're using it to cover operating losses, that could be a problem. I mean, because that's what they're going to ask you. I mean, yes, you can have a revolving line of credit and you can use it for whatever purposes. There's usually no limitation as to what you can use it for. But it surely ain't going to be very beneficial to for future financing if it's going to be used to cover operating losses. A willing creditor can make the difference between bankruptcy and continued operations. Yes, you must be in good relations with your bankers. And that is what I'm saying. Make sure you use those credit financings for operational needs, not to cover losses. What about investing activities? If you're going to buy a new company, new equipment, or you want to merge, you see mergers happening every single day. Well, you need credit for that, either through the issuance of new stock or more likely debt. How are you going to buy another company? Usually you're going to buy it via debt or some combination of debt and equity and some cash. Like I said, long-term debt is really used for these startups and growth. But again, too much debt can be dangerous, as we all know, because of higher likelihood of bankruptcy. But nevertheless, if you can make the argument that the investment is going to boost the value of your company by acquiring a very important organization for synergistic purposes, you might make an easier case. For financing activity, you really don't see so much of the credit demand for this, because again, like the other one is for investing activities like acquiring a company, but for financing activity, you're usually going to be seeing a lot of this in the equity section. Or common situations, a bank loan or a bond comes due and you don't have the funds, so you need to refinance. Funds to pay dividends. That's not a good thing. And there's something also called what we call evergreen debt, when a company consistently pays off debt by taking on more debt. It's those things. As an analyst, as a valuator, you need to take a look at. And if you see this could be red flags to you all. So it's important that you look at these things. That's what I'm saying. This chapter looks at things from a little different perspective than we normally cover. Here, when you're not a banker, you still need to understand the company's financial health when you're doing evaluation. Because like I said, when you're doing evaluation, you need to first do financial analysis. And this is very, very important. And who are the suppliers of credit? You got non-bank financing, you got bank loans, you got trade credit, publicly traded debt, lease financing. Here's the supply of credit. These are your options. And now you even have things like crowd financing, which falls under the non-bank financing. In the United States today, it's been approved by our government that you can actually raise money through the internet and then with very little regulations. So that's one of the more popular ways. And again, we could have a whole course just on crowd financing, but that's something very popular in the United States currently. Trade credit, we all know what trade credit is, from your suppliers. They give you a line of credit to buy their merchandise. And it's often non-interest bearing because they want you to be kept as a customer. Because suppliers often tailor contractual terms to protect the customer's existing creditworthiness. In other words, I have a relationship with this supplier. They say, okay, you can buy from us. We'll give you a $5,000 line. If you continue to pay us on a regular basis, we'll increase it to $10,000. But that line is only for that supplier. And this is very, very common. Bank loans, again, it's structured to meet client needs. You can either get a revolving credit line, or lines of credit available credit to be used as needed. Letters of credit, financing feature where a bank is interposed between two parties. It's a letter of credit. This is used a lot in international transactions. But generally speaking, do you have a revolving line or a line of credit? It's available on demand. And this sometimes is used to carry you through, especially for operational activities. But if you're starting to use these short-term borrowing for long-term ideas like buying equipment, then there's a problem. Because remember, there's one of the key things about finance is that you need to match up the maturities. Long-term acquisitions with long-term financing. Short-term operational needs with short-term financing. You need to match the financing terms with the goal. You got term loans from banks. You got mortgages. Mortgages not just for houses. People usually think, oh, it's mortgage. It must be talking about my property. It's debt instruments based on collateral. So any kind of collateralized based debt instrument is called a mortgage. And it's like real estate, typically with real estate, but it could be equipment mortgage. It could be equipment mortgage whereby the equipment itself might be held, or some other equipment might be used as collateral to make sure you pay up that particular loan. You got non-bank private financing, like private equity companies and so forth. You might even have insurance, pension funds, and all of them who have money to invest. And, like the big one here is private equity firms, and they usually are interested in your firm for potential acquisition many times. But if not that, at least fund you at a higher rate of interest so that they could give better returns to their investors and their private equity fund. So you have all these kind of structures. I don't want to bore you to death with all these, but these are common. Lease financing, is used for the acquisition of capital equipment, machinery, computer equipment. You have lease agreements. It's like supplier credit terms. It's the same thing. When you want an equipment, a copier machine, there's lease financing. So, again, it considers the collateral and the credit risk and the lessee will determine the terms. But, if you're using an equipment and, I'm using a copy machine, well, I'm going to pay it off over time, every month. And the amount that they will allow you to borrow, to be able to use to run the machines is based upon the quality of your rating. In other words, I may be able to get myself a $5,000 copying machine, but if I want to do financing for a $25,000 copying machine, they might not do it. So a lot of it is based upon your particular history. Now, what about bigger borrowings? This way, if you talk, you're talking about mundane operating cycle financing, you can use a line of credit. But if you're talking about big time financing, in other words, to acquire a company or to build an edifice or whatever, you might want to go through the publicly traded route. And there's different routes. This again is only if you're a publicly traded company. You have something called a commercial paper. In the United States, this is something whereby it's an IOU, very easy to, issue. It doesn't require a lot of regulations, but you have to pay it back within 270 days. It's one of these kind of situations, and only the AAA rated companies can get this can issue commercial paper because it's not secured by anything. Bonds or debentures, again, these have to be regulated by your securities regulators in the United States. It's the Securities and Exchange Commission. But any of these kind of bonds or debentures are ones that are non-collateralized. They need to be registered with the government. And the main thing about it, we'll talk about these concepts a little bit later on in the course when we talk about bonds. But for now, just understand a bond is a guarantee that I'm going to pay you back interest and the principal at a fixed term. That's what these are. So now the thing is, but there's also, like I said, in the United States, we have something called crowdfinancing, whereby you can raise money through the internet. And there's different types of crowdfinancing, but there's a lot of different ways to try to get some funding for your established business. But now let's take a look at this thing where we're dealing with what we call credit risk analysis. It's to quantify credit losses so lending decisions are made with full information. And to determine what my expected credit loss will be is what is my chance of default versus the loss given default. So what is my debtor's ability to repay the debt and the size of the loss if debtor defaults. So you come up with some estimated expected credit loss. And how do you determine that? Past history. You can take a look at what is typical of your company's lending practices and what was the result of it. Or you can take a look at this company's history and see if they have historically been very good or kind of shaky. So once again, you need to but it's something, it's called an expected credit loss. And in some areas, when we'll talk about it in a different course, something called value at risk. What is the maximum that I can lose on any given day? Those are what we call risk management techniques, and we'll be talking about that, I believe, in MBV1. So let's take a look at credit analysis. The purpose is to quantify the risk of loss. Well, it involves several steps. 1, assess the nature and purpose of the loan. We'll talk about that. Well, the purpose of the loan is, what's the loan for? Some reasons are better than others. If it's to cover my losses, that's not a good reason. You might not do so well. You got to assess the macroeconomic environment and industry conditions. You need to perform a financial analysis, and you perform prospective analysis. And you see, the whole idea of doing credit analysis is to do the performance of a financial analysis. And all of this, then, from the information you gather here, you'll be able to do evaluation. Because if all these things are negative, the financial analysis is not saying it's so good, your industry conditions are not so hot, well, that's going to lead you to a negative type of evaluation. Evaluation is not done in a vacuum. You need to take a look at the broad picture. And that's why it's important to understand about credit analysis. Very important. So, let's take a look at step 1. Evaluate the nature and purpose of the loan. Why is a loan necessary? Is it for cyclical cash flow needs? Well, that's not bad because it's just temporary. Fund temporary or ongoing operating losses? I don't like this so much. Major capital expenditures? Yeah, I mean, if it's if it's for long-term financing, reconfigure capital structure. Maybe you want to be more leveraged than equity or vice versa. I mean, you need to determine why the loan is necessary. But I'm very careful about it to cover ongoing operating losses. This says that there's a flaw in your business, and I'd be very leery about lending money for this. This is okay because, timing's cyclical, you may have to pay your suppliers, but the money's going to come in soon. Temporary needs are not bad, fund temporary needs, but not ongoing operating losses. That to me is very, very dangerous to do such. Step 2, assess the macroeconomic environment and the industry conditions. How well is your industry? Like Porter's 5 forces. Now, we're talking about that. Is it easy to come into this field? Can anyone open up a store and be competitive, or is it really tough? Buyer power can be a credit risk if customers have the ability to demand price concession. Hey, if I have price concessions on you, I won't buy from you unless you lower your price. That's a concern for the company. Supply power. If suppliers have strong bargaining power and can demand higher prices. Yeah, what about the other side of it? They may demand on you. We won't supply you the needed raw materials for your production unless you play our game. Hey, these are things you need to look at. This is a supply chain. And that's why there's a whole discipline of supply chain economics, supply chain financing. You got all of these things that you need to consider. Then you have things like assess the macroeconomic environment, like threat of substitution. Hey, I may have a particular product, but there may be, if I charge too much, I could go to my competitor who has something similar. Threat of entry. What happens if my field is very easy to get into? You have a tutoring business. Well, how hard is that to get into a tutoring business? Well, it's pretty easy. So all these things you need to consider when you're doing evaluation. That's why I like to talk about the Porter's Five Forces, because it gives you an idea of things which you consider when you are doing this. Step 3, analyze financial ratios. This course is on financial ratios. We already touched upon that a little bit earlier, but we're going to be doing a whole lot more. Includes analysis of the financial statements and ratio calculations. You need to make adjustments for one-time events, and this is all these concepts. All these concepts are so important because this is also going to affect your valuation. Because everything I'm saying here needs to be considered when you're doing a valuation. For example, you don't include one-time events in evaluation because that's not representative. What you want is your core business. It includes all operating assets and liabilities. That's important. We're not concerned about non-operating assets, things which are not part of my core, because that affects the valuation. It has no meaning to us. Considered items that may distort operations. Anything that could distort your operations or is not really representative of your business should be removed. But when you do your ratio analysis, that's what I said. Financial ratio analysis is not just a matter of just going to the financial statements and plucking in numbers. You need to take a look at how those numbers are derived, what numbers should be included, which numbers should not be included, and should they be modified as well. You're going to do things like profitability analysis. What's my net operating profit margin? What's my net operating asset turnover margin? And you notice, as I mentioned in the previous chapter, we're only dealing with operating. We're not dealing with net profit margin. We're dealing with net operating profit margin. We're not dealing with asset turnover. We're dealing with net operating asset turnover. And it also excludes items that will not persist, such as one-time charges. Again, we want this company to be clean. When we're doing this valuation, we want it to represent a company that's representative of its activities. We don't want to show that, we sold some land in Alaska because we decided not to do anything with it. Well, you don't want that in the valuation, because what does it have to do with your core business? It's always about understanding what is my core business. And from that, you do the valuation. And you even do that for financial statement analysis. And now also, when you're looking at this, when you're doing prospective analysis in the future, while looking at the past is not always going to guarantee what's going to be in the future, as we all know, it gives you a guide. You should be able to do ratio analysis based on this forecast. And also you got to determine, let's just say your company structure is 50% equity, 50% debt. Are you going to stay that way, or is that going to change? Another thing that you need to consider. If you think your structure is going to change, you need to consider that in your financial analysis, because that's going to affect your valuation. Because you're going to be learning in valuation, we're going to talk about what's happened in this, what we call this forecast horizon. Forecast horizon is how many years can we predict in the future to show our net cash flows. Well, if you're going to have cash flows, you need to know, 5 years from now, I'm not going to have the same amount of equipment. I have to buy new equipment. So you need to know all this. And how are you going to buy the new equipment? Is it going to be through debt, or is it going to be through equity? So it's a whole lot. It's more than just taking numbers. You need to anticipate what you think your company's forecast is going to be. Yes, it is a guessing game. But guess at least has to be supported to be able to justify the numbers that you have. Now, what about this loss given default? What are some of the red flags that can lead you to believe that your company may be going to default? Well, fail to make payments, you violate your loan covenants. In other words, you're not supposed to, you borrowed money and the covenant said you're not to borrow any more money, and yet you go ahead and borrow money from another source. So again, you need to look at this as a evaluator, because it's also, if they decide to violate it on purpose, that should tell you something about the company, which gives you, fuel for thought about, do you trust the numbers that you're seeing? Remember, one of the early stages is you need to take a look at the internal controls of these companies. And if they're deliberately violating a loan covenant, what does that tell you about the other numbers? It might make you very, very skeptical. Okay, well, take a look at this. How do you minimize loss? Well, you can structure the credit terms various ways. Credit limit, repayment terms, collateral, covenants. The thing about it, though, is we're going to go over all of these things, and they're pretty self-explanatory what these are, but the trade-off exists if the lender is too strict with the loan terms, causing the borrower to default. Hey, you don't want to choke the borrower either. I mean, you got to make sure there's room for operations here. But the main thing to understand is that, how do you minimize loss? How do you protect, I'm the bank, how do I protect myself from losses? So you need these 4 issues, and let's just go over them. Let's take a look at first one. Let's take a look at credit limits first. The maximum amount a company may be loaned at a point in time. Limits are set based upon experience and by firm-specific analysis. Trade creditors, what you get from your trade creditors, low limits for new customers, higher limits for established customers. Credit limit, banks, credit limits on revolving credit. If credit rating falls, credit limit may be reduced. Common sense. I mean, if you're a new customer, you're not going to start off very high. Ones that have proven themselves over the period of time will get a higher limit. Banks, they don't have to give you a whole lot of revolving credit. They may say, hey, you can use up to $10,000. But if your rating falls, they may automatically decrease it to, like, say, $5,000, and that's going to be part of the agreement. But again, it's common sense. How do you limit your loss? Well, don't give a lot of money to lend out. Collateral. Well, collateral is property pledged by the borrower. Well, that's really good. You got personal property, real property. Best collateral is high-grade property such as securities with an active market. Values known and liquidation is straightforward. What about if my collateral is intellectual property? Well, good luck in selling your intellectual property. You want something that you can sell right away. So if they default on it, well, I could sell their collateral. I bought this machine for $1 million and it's secured by all my stock that I have. Well, I could sell my stock in 5 seconds for $1 million. That's okay. So it's important. But good luck in trying to sell your goodwill, right? So like I said, it's got to be good property, good collateral. That's why banks only like tangible. That's what banks, when we get into it, they like only what we call tangible ratios. They don't like intangible ratios because intangibles could get them in trouble. Repayment terms. Well, you could give them early payment discounts. The longer the term is out there, the greater the chance of default. So, the thing is, longer terms, greater chance of default, greater credit risk, and higher cost of debt financing. I mean, it's pretty straightforward here. Keep it short. And you could give them longer life debt repayment terms if they have proven themselves over the years that they've been very reliable. But in the beginning, you have to be very careful. You don't want to give very long terms to a newbie because that newbie may not be able to repay it. So it's very important that you at least consider that. And the last thing you could have is something called covenants. Where you could say, well, it's part of the loan agreement, and they may say that that those that restrict the borrower from taking certain actions, such as preventing mergers, you may have to keep your financial statements meeting these certain ratios. It's very important, these covenants. These covenants pretty much tell you what you can and cannot do. If I borrow $1 million, it may say you cannot borrow from any other source. And it may say that my current ratio has to be kept at this ratio. My debt equity must be at this ratio. So it could tell you very specifically. And what they'll do is the bank will actually send out auditors, their internal auditors, to examine and make sure that you're following the restrictions of the covenants. Now let's take a look at what we call coverage ratios or coverage analysis. Other books may call this debt ratios or leverage ratios. I don't care what we call it. But the ones I'm going to be explaining now are generally called coverage. And because what they're looking at is, can you pay back the principal and interest payments when due? This is extremely important. And that's why sometimes you might even see these things on the solvency ratio categories. And generally speaking, they consist of 4 ratios. And again, there could be more than that. The most common one is times interest earned. Others are called EBITDA coverage ratio, cash from operations to total debt, free operating cash flow to total debt. All these different ones and many variations of this. But the key thing is, can you pay back the interest? And even the formulas I'm going to show you, there's many variations to them. But the idea is, don't lose sight. Can you pay back your interest? Another one would say, can you pay back interest and part of the principal payments when it's due? Others will say, can I pay based upon my cash ratios as opposed to accrual ratio? I mean, they're all variations of the same thing. So just let's take a look. Earnings before tax plus interest expense, or if it's interest expense. And these are one of the few type of ratios you can say the higher the better. I mean, usually I give you warnings about avoiding rules of thumb. But here's, in these particular circumstances, you can simply say the higher the better. Reflects the operating income available to pay interest expense. And this only assumes interest must be paid because the principal will be refinanced. And there's other ones that assume that you could pay your principal too. I mean, there's all different ones. EBITDA, EBITDA is a non-GAAP performance metric, but sometimes EBITDA is probably the most commonly used metric in Wall Street. I mean, it's a poor substitute for cash flow from operations, but a lot of times EBITDA is used because, remember, what they're trying to do is back out all these things, interest expense, depreciation, and that's what they're trying to do with cash flow from operations. But cash flow from operations doesn't have any accruals there. EBITDA does. So again, you got all these variations, and you can just take a look at them. I'm not here to make you memorize these things. It's not important. But what is important is to recognize what they are and to use these things. Now, this is about, what about, do I have cash to cover debt payments? And there's another one, cash from operations to total debt. On the CFA exam, the Chartered Financial Analyst exams, they tend to focus a whole lot on cash flow metrics because they realize accounting is based upon accruals. Cash flow ratios are very important. I mean, you may have all the accruals in the world, but do you have the cash to pay the debt? So that's what this one talks about. 32, it talks about, considers excess operating cash flow after cash is spent on capital expenditures. So here we're talking about free operating cash flow to total debt. There's another one. I haven't seen a whole lot of this one used, but it's a good one. It shows you one way of calculating free cash flow. This is one variation of it. I mean, among 20,000 variations of operating cash flow. But remember, it's always based upon operations, right? So again, I wanted to show you some of the more common ones for coverage analysis, but this is not the only one. There's many, many variations to all of these types of ratios. Now let's talk about liquidity and solvency measures. I showed you coverage, and sometimes organizations or analysts will put coverage ratios under the solvency ratio. And a lot of times you may see liquidity ratios put under solvency. Like I always say, I don't care what grouping you put them under, as long as it makes sense and as long as you include what is relevant to include. You must have liquidity ratios, and I don't care what you call them, because can you pay your short-term bills? It's very important. I don't care what you call them, but it needs to be put in there. So liquidity refers to cash, how much we have, how much is expected, how much can be raised on short notice. Hey, you could be plenty of good assets, but if you can't sell it quickly, that's a problem if you have bills to pay. Solvency refers to the obligation to meet obligations, primarily obligations to creditors, including lessors. So now let's just take a look at some credit raters. Credit rating agencies assess credit risk. Those are Standard & Poor's, Standard & Poor's, Moodys, Fitch, and all of them. They differ from other lenders. They have no direct financial involvement with the companies whose credit they are rating, have access to better and more current information, can refine risk analysis across industry, because they do all industries. But here's I'm having a laugh about this. You know, the mortgage crisis situation with the mortgage-backed securities, these rating agencies were directly involved with those companies. They were actually advising them how to put those pools of mortgages together. Yeah, so they were involved, and there were lawsuits as a result of that. But yeah, I get a kick when I read this thing. But on paper, they shouldn't have any direct involvement with companies they're doing the credit ratings on. They were rating those mortgage-backed securities of the companies they were rating. It was incredible what they found out. That's how bad it got at that point. You know, they give opinions as to entities' credit worthiness. Can they make payments due? These are standards of poor's. When you do your ratio analysis and credit ratings, I mean, these are companies that do that. Credit analysts are rating agencies, consider macroeconomic events, industry and firm-specific information, assess chance of default and ultimate payments, provide ratings on both debt issues and issuers. Well, you know, let me explain this. Let me say this much. These are the reports that you as evaluator will use when you're coming up with your industry analysis. You don't have to reinvent the wheel. This is the information that you will use to be able to do such. When I tell people, when I do evaluation, where do I get the information from? I can't possibly on my own do all research on my own. I get it from companies that specialize in it. So I may go to Moodys and say, well, let me take a look at the industry analysis, or IBIS World. Let me take a look at their industry analysis. That's how you do it. So, I mean, you don't reinvent the wheel, but it's got to come from good sources. In other words, it can't be from some blog. It's got to be from Moodys and S&P and Fitch, who are known as top-rated credit rating agencies. And you can see, you know, S&P, you know, how they do ratings, you know, and Moodys and how they rate bonds, for instance. And they're very similar. The terms are slightly different, how they call it. Investment grade is AAA, AA by Standards & Poor's. And you can see how they write it at Moodys. And you can see medium quality, you know, BBB. Here, medium quality is BAA1, BAA2. So again, but the main demarcation line is what we call non-investment grade or investment grade. Non-investment speculative grade, sometimes it used to be called junk bonds. And there's levels of this too. You know, and the whole point about this is why it's important is that some corporations and some agencies may be prohibited from investing in these kind of debt instruments. So it's very important as an evaluator to see if you're looking at your company, where is your company's credit rating standings? Where is it? Is your company's at the level of investment grade, or is your company in the non-investment grade? And that can play a big role in your valuation. Why do companies care about their credit ratings? Well, the worse credit they have, they're going to have to pay a higher interest rate, and they may be restricted in terms of more funding. And like I said, certain investors will not invest in their debt if it's considered non-investment grade, as I mentioned earlier. There's limits to this stuff, and you know the point being is if you got bad credit, your interest rates are going to go up. So that's a big issue to consider. Now you can see, how is risk linked to credit ratings? Well, you can see, you know, for example, the 10-year treasuries, that's the U.S., you know, what kind of rates? It's the lowest, right? And this one, the BAA, which is medium grade, is higher than the AAAs. But yet nothing is lower than the treasuries because that's risk-free. United States, backed by the U.S. government. So yeah, is there a relationship? You better believe it. You better believe there's a relationship. And what I found interesting is you want to take a look at the distribution of companies' bond ratings. You can see the vast majority of them are BBB plus or BBB, and this is where most of them are. Very few are AAA rated. And these are the ones, when you're in this category, those are the ones that can issue the commercial paper, the ones that I told you about, the ones that are issued for 270 days or so, you know, without getting any SEC approval. They got to be right in this category, the AAA and the. But you can see where most of them are. You know, then they're borderline, you know, investment grade. You know, so that's what they are. Now, no one's going to tell you their secret source, but all of these companies S&P, Moody's, Fitch, they all have their own ways of doing credit rating, how they do their ratings. But they all have some things in common. There are some things in common. For example, they will look at macroeconomic events. They will look at how the industry is doing. And then they'll do their ratio analysis. They'll do the ratio analysis. And, and then they'll present their findings, the analysts, to the rating committee for review. And the rating committee assigns a rating. That's how it's done. But it's nothing magical here. But what's magical is how they go about adjusting financial statements, how much weight do they give in a particular area than others. And I have some nice stuff to show you at the end of this presentation. But that's how it's done generally. That's how it's done. And what I find also very interesting is, ratio values for different risk classes of corporate debt. So you can see the AAAs, what are the criteria that they're looking at to get a AAA versus a AA or versus the Bs. You can see, and they tell you EBITDA over average assets, EBITDA over margin, and they tell you what it is. And, and they give you these numbers, and you notice there's a relationship. Now, for example, AAA and AA, you can see the ratios, and it fits pretty much why this is better than the others, and they show you. But it's not always consistent. Like single A, the EBITDA to average assets is a little higher than AA, but in other categories is lower. So you can see how they go ahead and do this. You can see what ratios they focus on, and that's what you need to consider yourself. And this is what you need to look at. Saying, hey, if you're valuing a company, or you're looking at their debt instruments, what rating would you give them? Well, you can see what kind of ratios they have. You can see what ratios they use and see where they fit in. What numbers do they have? And you could tell them, based upon looking at that, what ratings they should be given. Okay, what about bankruptcy prediction indicators? You got all this stuff, and this is the Altman Z, and there's many variations to Altman Z. So let's just not think this is the only one. There's ones for non-manufacturing versus manufacturing ones, and there's ones for different industries. It's getting much more elaborate than it was originally. This is the basic model which they use, and they tell you the formulas. It's, for example, you gotta, the Z-score is 1.2 times working capital total assets plus 1.4 times retained earnings, and they come up with all this stuff. There's one for private companies, one for public companies. There's all variations. And you'll be seeing a lot of this stuff, but then when you take a look at your Z-score interpretation, they'll tell you, if you got a Z-score of over 3, it's a healthy company. 299 to 1.8 is in the middle, or less than 1.8, you're going out. And, when I'm talking about going concern issues, when you're talking about, as a CPA, doing a going concern issue or doing a valuation as a going concern issue, hey, this is what you should be basing it on. I mean, there's other models that can help you. There's other models that can help you with this stuff in determining bankruptcy, but here's one of the most common ones. So if you take a look at this one, here's a company, Home Depot, which is an American, home appliance and do-it-yourself hardware store. Their number came out to be 6.7, which shows a very healthy company. But yeah, but there's a lot of variations of this, and there was a recent academic paper just on Altman Z. There's a whole slew of these things. And again, in statistics, we'll learn about, the types of errors. Type 1 error is a false negative, or a situation where the Z-score indicates a company is healthy but goes bankrupt. Then you got a type 2 error where it falls positive, or a situation where the company is projected to go bankrupt, yet the company is healthy. You got all these things, and there's a lot of academic papers written on this stuff. Very cool. It's interesting. But Altman Z's always been around as one of the best ones. And then here, they're showing you, without giving too much of their secret away, what does S&P do versus Moody's. Moody's has 4 factors they look at. S&P has more. But they're all going to cover the same thing. But you can see the emphasis that S&P uses, and you can see by the size of it. Industry characteristics is very large. So you can see by the size of the box how much weight they're going to be giving these things. Like competitive position is very important, obviously. Profitability is important. And this is how S&P actually goes ahead and does their ratings. They're not telling you exactly the numbers, but you got a good idea what's important to them. And then you see Moodys. Moodys does the same thing, but they broke it down into 4 factors. And you can see this again is very important. Product portfolio profitability. These are the 2 dominant ones. Then you got financial policies, and then you got financial strength. But you got the idea why this is important in valuation. It's important in the sense that the credit ratings can give you a good indication where your valuation is going to go. Pop more in a positive value or more in a negative value. This concludes Module 2.